This flurry of letters being sent out, and also this 3-week reprieve, more time to talk.
Well, the first news, of course, is that the deadline of July the 9th, it does look like that the 3-week reprieve here could be very important for markets, because now countries do have a chance, of course, to come back and give some counter offers and some estimates of what level of tariffs that they would like to have, and the negotiations can then begin. On the other hand, for markets, trade war uncertainty has been coming down, but now, of course, trade war uncertainty is going to go up again, because now there is more uncertainty about what does it mean in terms of business planning, what does it mean in terms of how countries can think about what level of tariffs we are ultimately going to end at. So the short answer here is that trade war uncertainty had been coming down somewhat, but now as we've been approaching the deadline and we've all been trying to figure out what's going on, now we have a little bit more time, but now the next few weeks obviously become very important, because now the next deadline that we are looking at is, of course, August the 1st.
Indeed, yeah. I mean, you're an economist, Torsten, but I mean, you know, you've got to be, these days, sort of an expert in psychology as well, right? Trying to read or figure out what's going through President Trump's mind. I mean, the easy read is, look, this is Trump, this is the deal, this is start with a maximalist position and then soften it up so that at the end of the day, make it easier for the other side to agree to a deal. But this is also hardball, is it not? And, you know, at first I thought, well, this is sort of like for buyers, when you want to buy something, this is sort of like a reverse auction, right? If you don't take my offer now, the next one's going to be even lower. This is a reverse auction. If you don't take the offer now, the next offer is going to be higher.
Yeah, and that's why what really is the key here is how a company is going to respond. A company is going to respond by saying, well, we will now start to hurry in imports and we'll start to get things in before tariffs go up. Or a company is going to wait and see and therefore delay hiring, delay capex decisions. So therefore, the macroeconomic data and the impact on the economy still remains very unclear.
We've seen some of the former already, right?
Yeah, and that's why in the US, the good news has been up to this point that inflation hasn't gone up much, and the employment report last Friday was actually surprisingly strong. So in that sense, companies have basically been in wait and see mode with not raising prices and not laying off workers. But the question now is that we have this added layer of uncertainty. It is only 3 weeks, but still it is, of course, clear that companies could begin to respond by now saying, well, this is something that is finally going to make us now say, now we are going to lay off workers, or now we are going to raise prices. So that's why the corporate response is going to be absolutely key in this situation, not only in the US, but of course also here in Asia.
And the timing, goodness, so we've got the next set of earnings just around the corner, right? Now, I've heard you talking about the impact of tariffs, about $400 billion worth, right? And the key question is, what are companies going to do? They've got basically two choices, right? They can pass it on to customers, which could potentially lead to inflation and not help the economy, obviously, right? Or they could eat it at the margin, which would be not good for earnings. Which way do things seem to be leaning right now?
That's exactly right. That's why up to this point, if you look at the U.S. economic data as it's been coming in for the last 90 days since April the 9th, when the window for the 90-day counting started, we have, exactly to your point here, not seen much increase in inflation, and at the same time, we've not seen much deterioration in the economy. So that brings exactly to the conclusion here, when the earnings season begins over the next several weeks, what we should be watching is who is it that ultimately will be paying for the tariffs. So far, the U.S. government is raising about $30 billion every month. So at an annualized rate, that's in round numbers, close to $400 billion in total. So the question is, who is it that's going to pay $400 billion? Is it consumers in the form of higher prices, or is it companies in the form of lower earnings? And at this point, the earnings season we had in Q1 was quite strong. So the fear you can have for this earnings season, and therefore the fear for the S&P 500, is that we will begin to see some weaker data in the earnings reports that come out over the next week or two as the earnings season really starts, because the $400 billion will have to be paid by someone. There is no free lunch. Someone needs to pay the higher tax revenue that's being collected. And this is where things become very important for markets. Namely, it is likely that this will begin to show up in earnings for the S&P 500.
Uh-oh. Sherry, come in on this.
Yeah, and in the meantime, we've got the U.S. market, sure, looking a little bit damaged just overnight, but the resilience is pretty remarkable as well. Perhaps, yes, margins will take a hit, but it would be not as bad as it would have been because, well, thanks to, of course, the fact that oil prices are not too egregiously high, and artificial intelligence that could be somewhat supportive of earnings growth in the United States. How speculative is that?
Yeah, no, you're right. There are, of course, other factors going into what's going to happen this earnings season. But that being said, as we all know, the concentration in the S&P 500 is really striking. We are approaching that the Magnificent Seven. They make up as much as 35 to 37% of the index at the moment. And that's been rising again in the last few weeks. And that concentration is, of course, also problematic because that raises the demand for earnings growth from the Magnificent Seven and from the AI story. So the fear you can have for markets is that given there's now so high expectations to what the tech companies will be delivering, that of course raises the risk that if they do not deliver, because markets are expecting that we should be seeing earnings growth slow down for the Magnificent Seven. So the challenge for the S&P 500 is that it really is not, at least not at the highest level, 500 different stocks that you're buying. If you're buying the S&P 500, you're really mainly buying into the AI and tech story. And given that that is now going to be impacted by slower earnings growth and the concentration is so high in the index, that does mean that the S&P 500 does not offer much diversification. Instead, it really is mainly the AI and tech story that's been driving things up here in the last 2 months. So the conclusion is, therefore, we are a little bit worried that if the S&P 500 is driven just by a small group of stocks, then the fear you can have is that those stocks have to deliver a lot. And in particular with the geopolitical and macroeconomic backdrop that we're talking about today, then of course the bar is raised for the S&P at this point.
So Torsten, you're talking about concentration risk, right, which we've been talking about for months now, right? But with the Mag 7, right, I mean, these guys are not products, right? There's not goods shipped across borders, right? These are services companies. Aren't they going to be more immune to tariffs?
So that's why what is so critical at the moment is what is going to be the response from the trade partners. A lot of discussion, of course, has been around digital services taxes. So Trump's tariffs only focus on goods, and there's also trade in services. And the U.S. has a surplus in trade in services with a lot of countries, because a lot of countries, of course, import services such as Netflix and, of course, also other similar types of digital services. So those things, of course, are now suddenly becoming very important, because if countries such as Europe, Canada, others suddenly begin to apply a digital services tax or a tariff on the digital side, then, of course, it could be a whole different discussion. So that's why the response of the rest of the world now also becomes very important, because that could potentially be very important for the Magnificent Seven.
Yeah, kind of good news that maybe that Europe didn't get a letter, Sherry.
Yeah, and what about the direction of the dollar, Torsten? So I would imagine the dollar decline could be somewhat stimulative for the U.S. economy, but it could also be inflationary as well. Your take? What's your outlook for the dollar direction in the second half of this year?
Yeah, this is very important. So if we just step back for a minute and think about what the dollar has done for the last 6 months, it is, of course, very clear that the dollar has gone down 10% in trade-weighted terms. And models, including the Fed's own model of the U.S. economy, would tell you that when the dollar goes down 10%, inflation over the next 4 quarters goes up by 0.3%. So a lower dollar means higher inflation. And this comes, unfortunately, at a time when inflation is already under upward pressure from tariffs. Inflation has also been under upward pressure because oil prices are up since the beginning of May. And we also have inflation under upward pressure because of immigration restrictions. So deportations at the moment is running roughly at an annual rate of around 1 million people are being deported from the US. That's also putting upward pressure on wages, especially in the sectors where unauthorized immigrants are working. That means in construction, in agriculture, in hotels and restaurants. So the bottom line is that inflation, as you can see on the chart, has looked relatively stable. But the conclusion is that Jay Powell did say on 3 different instances over the last 3 weeks that he thought we shall see and we will see a meaningful increase in inflation over the coming months. And he said that tariffs would be the main reason why he's expecting inflation to go up. So adding, Cheryl, here, the dollar going down, that means that we already have upward pressure, and the dollar lower also puts upward pressure on inflation. So the fear we have is that inflation is going to stay higher, and therefore rates are going to stay higher.
That's unusually strong for a central bank chair to say.
That is very unusual. He said this both at the press conference. He said, we expect a meaningful increase in inflation over the next couple of months. He said that again at the congressional hearings, and last week in Sintra, he also mentioned it again in outside Lisbon in Portugal. So that means that it is a lot of credibility he's putting at stake by saying we expect inflation to go up. And that's the challenge at the moment, that if trade war uncertainty is coming back, and therefore businesses begin to hold back with their decisions, it could come at a time as a stagflationary impulse where businesses both are holding back with their spending, and at the same time inflation is moving higher, not only because of tariffs, also because of a lower dollar, and also because of immigration restrictions, and also higher oil prices. So the impulse to inflation going forward is certainly to the upside.
And that has been your base case for some time now, stagflation. Or I remember a couple of months ago you're saying there's about a 90% odds of a recession in the U.S.
Yeah, that's when we looked at the April 2nd tariff. So if we are going back to the April 2nd tariffs, then we will go back and characterize this as what we have been calling a voluntary trade reset recession. In other words, it's a voluntary decision to do a trade reset, and with that comes, unfortunately, a recession. At the moment, our estimate of the likelihood of recession over the next 12 months is 25%, but if we look at the consensus, expects a 40% chance of a recession. So if we just summarize everything we have talked about, when the market and the consensus is telling you there's a 40% chance of something happening, in this case a recession, we should be taking it very seriously in markets, because that's of course a very significant downside risk to the economic outlook.
40% chance of recession.